Hey everybody, welcome to Trading Capital's exclusive analysis. Today is currently April 11th, and as we touch base on a few things ahead of the CPI, in this video we're going to be discussing some of the economic indicators we're looking at, what is transpiring in the S&P 500. We'll also touch base on the natural gas market and oil market, so touching base on energy because that is the main component in the CPI that has really been causing it to decrease at a drastic pace. And I think it's important to really understand what the global energy market is looking like, especially as we head into the later parts of the week when we actually hear from the EIA and potentially the global energy outlook for the remainder of the year. Now, looking at the S&P 500 here, obviously we all know that inflation, the CPI headline number comes out tomorrow at 8:30 a.m. Right now, the markets are extended. They have been consolidating for 2 weeks, but it's not enough consolidation, specifically since you're at a key resistance zone that is acting as hard resistance and has acted as resistance before in the past. This is the weekly chart of the SPX. One level I want you to bring your attention to. Let's say the market takes the CPI print as a good number. Let's say it beats the market expectations or comes in line and stocks rally. The big resistance point is this 41.62 on the SPX. The reason this is a massive level is you have this massive multi-week bounce support zone, massive breakdown zone, once here, twice over here, another failed breakout, capitulation, heavy sell to the lows in October, a retest over here. So that level has been a wall of resistance. The closest shot we got was back in here when buy the dippers were pushing it up, and it turned into be a failed breakout. And now we're retesting that area. So let's assume the markets do have a positive move tomorrow. Really, the upside is capped, in my opinion, to about 1.26%. Maybe you come up and hit this pivot at 41.95, but realistically, the upside is capped to about 2% on the SPX from my analysis. And then as we head later into the week, you have to be aware of the initial jobless claims that are arguably also going to be extremely important, which I'll touch base on in another video. But needless to say, lots of economic data that is transpiring. If you look at the daily chart on the SPX, you can see that the volume was light today, and you did get rejected off of this little resistance trend line and basically closed flat on the market session today. We opened roughly around 441.08 and we closed pretty much at 441.08 with a late session sell into the end of the day. People taking profits and paring back their position. All right, let's touch base on the downside. Let's say the markets take that sell-off as a negative. Really, there's one big level. This is going to be the big level that you retrace to and could be your buyable technical support if the overall volume trends are in support of that specific outcome. So upside's fairly muted. Downside, we have the key levels around the 4,000 level. This wide range green bar is going to be very pivotable for the bulls to maintain. As long as you can consolidate still inside of this wide range green bar, the odds favor a continuation move to the upside after more consolidation. All right, let's move along to natural gas as we'll touch base on that. So natural gas had another positive day today, still closing in yesterday's high wick, but needless to say, it was good follow through and an exceptional amount of volume once again. So it's showing that there's a lot of sellers that are here, but the buyers were able to keep propping it up and pushing it much higher. I think natural gas is very oversold. I think it is one of the most oversold commodities. So therefore, I do think you're going to see capital rotation into the specific asset, especially as we enter the season where we have to start restocking the reserves and starting to build up the reserves for the later winter cycle. That does approach fairly quickly, but for now we're obviously heading into the warmer season where natural gas typically isn't in of higher use, but you really want to know the cyclical and secular effects of natural gas and typically how this restocking season affects the price. Looking on the weekly chart, weekly pattern is intact. Two massive weekly reversal candles over here. A picture perfect retrace testing that double bottom. On the monthly chart, we also have that beautiful monthly reversal signal on volume, followed by a retest of this breakout bar. So these are the levels we want to take shots at. Obviously, we were able to add at the lows on natural gas with our members, so it greatly increased our position in UNG, which is awesome to see considering we have had a bounce. Now, we need to really keep seeing more follow through. The short-term positive, if you look on the 4-hour chart of natural gas, basically you had a hard reversal in natural gas. It looked like the pattern was in trouble. The big level I was watching intraday was it going to lose this 221.8 level? The market makers and the natural gas bulls were able to hold that price level despite this heavy reversal, and they managed to push it up and on a heavy volume candle that was actually traded more shares than that heavy 4-hour candle over there. So that's a short-term positive. However, we're going to need some consolidation to get through this heavy 4-hour reversal signal at this point in time. But needless to say, the fact that this chart finished up at the highs is a very short-term positive. And I do like that after this heavy 1-hour bar down, you were able to rally, consolidate, and pretty much recapture that red bar high on a closing hourly basis. So definitely some positives that's occurring in the natural gas chart. And obviously being long, full disclosure, I do expect more upside, and that's kind of how I'm positioned at this point. Let's move along to the QQQ, the NASDAQ. So the NASDAQ is interesting because it has been showing the most relative weakness out of the S&P and the Russell. And typically if the NASDAQ starts to show relative weakness and really starts to underperform, it's only a matter of time before it starts to drag the whole market down, the broad market, because of the simple concentration in the likes of Microsoft, Apple, Nvidia. So definitely pay attention to technology. Obviously, if the market takes the inflation reading as good tomorrow, yields will likely drop, and then that would put in a little bit of an algorithmic buying program to bid up tech. That's kind of what we've been seeing. However, I do think we're at a close point in the market where if yields, so let's say the 2-year yield really doesn't spike tomorrow, or doesn't drop tomorrow, let's say it just hovers here or spikes, then that's not going to be conducive for the tech industry to move higher. Typically the correlation is when yields are up, tech is down, and we'll just have to see if that correlation holds true. But eventually that correlation does break. We will get to a process in the environment, in the market environment, where yields actually drop, and then you'll also see a continuation of tech dropping, and that could be associated with a weakening economy in the sense of a weakening labor market. We'll just have to really pay attention to that. Let's touch base on oil finally, because that is giving us some insider indication as to what's going on. Obviously, a big component in the CPI tomorrow is energy. Energy has been slaughtered and definitely making strides of disinflationary pressures. But needless to say, the month of March, starting roughly over here on this green candle, indicated that oil, basically when oil closed at the high on March, here was around 77. So all of the data that we're getting in this next CPI report is taking into account April data, March data. So when you factor in that oil started at around 77.50, came all the way down to a low of 65, it looked like the disinflationary pressures in the CPI were going to continue, but now all of that has been reversed because you had a sharp move up in oil. Yes, there were a lot of days trading below, but basically you've had a move now which has sent oil closing near the basically almost near the end of March up at the highs here. So you can see that oil closed at the end of March really on this high pivot around 75. So it was kind of a nothing event for oil, and I think a lot of people were forecasting a lower CPI because of the big decline in oil, and being the fact that oil, that surprise OPEC announcement, bumped up and closed oil basically where March started. That kind of hinders a lot of the analysis, I think, that was done in March, early March, to give us an accurate CPI number. And if oil really hasn't impacted the energy side in the CPI report, basically that could mean a less of an inflation or a higher inflation reading tomorrow. And obviously the Fed is going to pay attention to the core PCE and aspects of the inflation that really haven't seen any downside pressure. It's been very muted in certain sectors of the economy where inflation is still actually trending higher. Likes of housing, food, and shelter and services have definitely been very sticky. And then you factor in now that we're getting higher oil prices, and this is trickling now into April higher oil prices, which would be the March CPI print for basically next month. That could be negative for the overall market. So definitely pay attention to the energy markets, because if oil starts to pick up and really stay around these levels, it will impact the next month's CPI as well. Definitely lots to pay attention to. Obviously, tomorrow is a market-moving session, so kind of wait for that first initial reaction. We've given you some upside targets on the SPX. We've given you some downside targets, and you just have to really pay attention to that aspect of the market. On that note, thank you all for tuning in. Please give this video a big like down below, and definitely comment what your prediction is for CPI. The market consensus is 5.1%. I'm going to go with 5.3%, and definitely leave your prediction down below. Take care, everybody, and we'll see you on the charts a bit later.